Since the beginning of the year, Tesla have fallen by 38%, almost 40, and since all-time high, the stock is down by more than 46%. Some people start thinking that Tesla is at a fair value, it's a good opportunity, it's time to buy to make some good profit. And in this video, I will show you the bear case, why I think Tesla is not a good opportunity, is not a good company to buy, and you should not have it in your portfolio. And I don't have it as well in my portfolio. So we'll go to the numbers with my little spreadsheet. Like this, I can have everything kind of easily. So first, let's talk about debt, which is actually the best thing about Tesla. It have a very good debt management. So net debt compared to EBITDA is negative, so very good. Okay, when it's under 3, I feel it's good. Under 1.5, under 2, very good. So here it's negative. That means that they have more cash than they have debt. So really good. Debt to equity as well, 20. It's very good. Under 17%, it's great. Interest coverage higher than 10. So here 95% in the score for debt. So that's really good. Now with growth, it starts to be a bit less good. It's not the worst, but it starts to be less good. The revenue had grown 42% per year for the last 10 years. And now the last growth of the revenue is 0.9%. And for the last 5 years, it's a cumulative annual growth rate of 3%, which is not really good. Okay, it was good like for the last 10 years, but now it really started to decelerate. The earning per share, kind of the same scenario, but it was negative in the last 10 years, so this two doesn't really count. But this one for the last 5 years, 32%, which is great. Free cash flow, same, 7.2%, not really great, but still fine, but 32% great. And the last one decreased by 50% and free cash flow by 17%. You can see it on FinChat. If you go to, you can have a look at net income, EPS, and we'll have a look as well at the free cash flow. You can see that the free cash flow is decreasing since 2022. Up, it almost got divided. It got divided by 2. The EPS declining since 2023. Okay, it got divided by 2, and the net income same, divided by 2. Declining. Okay, so we're at level where we were approximately in 2021, a bit higher, but that's not really bright for Tesla. The predictability of the company is 1, and you can see it like with net income going up, down, there is no predictability, so 1 out of 5. For the future, the revenue is expected to grow by 16% per year for the next 1 to 3 years. EPS same, 27% per year, and free cash flow 49% per year. Is it possible? I guess yes it is, but still it's very, very high number, especially for an automotive company. Even though there is those robots, there is plenty of other projects, but yet still it's really high. When it comes to capital allocation, very bad. There is no buybacks. Okay, so shareholders are being diluted by 1% per year, like for this one, and in average for the last 5 years by 2.8%. The capex is huge. 76% of the cash from operation is spent into capex, or it's invested into capex. 5 years ago it was 55%. And the stock-based compensation, now it's 55%, before it was 45%. It's huge. Stock-based compensation, just to remind you, I like when it's under 10%. Here we are 55%. It's huge. Even Google are not that high, and people complain about Google of having a high stock-based compensation. People complain about Salesforce having high stock-based compensation, and they are not at this kind of level. Like this is totally huge. And what is not really nice to see, it's as well how it's evolved. If you go here, stock-based compensation right here, you can see that the stock-based compensation are following the free cash flow. They are not declining with the free cash flow declining here. They're growing year after year. You have a cumulative annual growth rate of 29% for the stock-based compensation. And for the free cash flow, we'll start when it starts to be profitable. A 29% growth in free cash flow since it's profitable, 17% for stock-based compensation is way too high. Like the stock-based compensation is way too high. Okay, Now let's go for efficiency, operating margin. So we'll not count 10 years ago because the company was not profitable, but now, 5 years ago, it was around 8%. Return on invested capital, 3%. Return on assets, 3%. Now, operating margin around 7.8%. If you look at it more widely, you can see that the base year was 2022, it was 16%, and now it's more around 7.8%, 9%, but it's not a company that, for now at least, can go very high. I agree. For a car company, for a company that sells car, those numbers are pretty good, are amazing, but at the end, like, now 7.8% not really good. That's why it's only 20% grade for efficiency. Now return on invested capital 14%, return on asset 12%. It starts to be good. This starts to be very promising. Like you can have something good, but still not very, very good. When it comes to valuation, the share is now trading at $232. If you want to do 10% per year, you need to have net income growing by almost. If you want to do 10% per year, you need net income to grow by 33% per year for the next 5 years, okay, at this price, and with a PE ratio of 40. If you think in 5 years the PE ratio will be 40, and they manage to grow by 33.5% per year, you will do 10%. Do you think this is possible? I don't know. But 40 as a PE ratio is huge, okay? It's already huge. So I agree. Now Tesla is trading at very, very expensive price. Now the PE ratio is 110 and the forward PE ratio is 83. It's very, very big. Price to free cash flow 211, 142 for the next 12 months. So for the forward price to free cash flow. Like this is really, really, really big. A 40 PE is like it's really big. For a company that still dilute, here we didn't say that they will continue to give more shares. If they continue to dilute the shareholders, you will do 8%, you need 35%. Yeah, you need 35% growth. 35% growth if they continue to dilute shareholders, to have 10%. So the question is easy with Tesla is, do you believe it will be able to grow like this? If yes, then you may have 10% now, okay? If you don't believe it will go by 35% per year for the next 5 years, sounds a bit more difficult. What is the expectation? 16%, okay, per year. This is the expectation. So with 16% growth, if analysts are correct, you will do minus 5% per year on Tesla at $232. If you want to do 10%, okay, you need to buy it at $109. At $109 with 16% growth rate for the net income, you will be able to have a Tesla and do 10% per year. So, but there is other reason why I'm not buying this stock and why I don't plan to buy it, okay? There is 3 reasons other than valuation. The first one is too much a drama meme stock, okay? It's all about the CEO, all about Elon Musk. Elon Musk will say something, the stock will go up 20%. He will say something bad, the stock will go down 20%. Like you look at this volatility on the stock. Like the volatility is crazy here. Like it's really crazy. It go up, down, up, down. At the end of the day, since 2021, it didn't do much except going up, down, up, down, up, down. So this is the first reason why I don't plan to buy this stock. The second reason, it's mostly for now in the car industry. The margins are pretty low and it's a cyclical business. Once everybody will have a Tesla, yes, you can have some other revenue coming from it. They are working on it, but it's a car industry. The car industry, I don't like this industry. It's too cyclical. I really don't like it. I don't like this industry. The margins are low, too cyclical. The return are not really good. So, okay, Tesla is better than the others. They have better balance sheet. They have a better product in the sense that they have a competitive advantage over the other cars. But yet I will not risk to invest because it's in the car industry. Third reason, there is too much hope for the future. With robotaxi, you have other things, other product in development. A lot of people start saying that Tesla is not a car company, Tesla is a tech company. Tesla is way more than a car company. If you think Tesla is just a car company, it means you don't understand it. Okay, they may be true, okay, they might be true, and I hope they are true. I hope they find the good thing, but here I'm not saying it cannot be great and it cannot bring revenue in the future, all of this. Just in history, companies that people bought too expensive because of their bright future, because they think the revenue will be so great in the future while right now it's not really good, they didn't perform well. The best example I have is from the book Stock for the Long Run with Jeremy Siegel. It's about IBM and Standard Oil or ExxonMobil. I don't remember which one was it. I think it was ExxonMobil maybe. But the thing was, years ago, decades ago, IBM was a stock, like number one stock, the future. Okay, everybody was saying IBM is the future. They saw in advance on everybody. It will be great. You took it 20 years after, while Standard Oil or ExxonMobil wasn't great at all, in the sense that everybody was saying that, okay, petrol is the end, now we'll not use petrol anymore, petrol is disappearing and everything. At the end, ExxonMobil or Standard Oil, I don't remember which one was this, if someone can help me in the comment with this, still performed better, still had a better performance than IBM, and the reason was people bought IBM way too expensive. They expected way too much growth and they paid a price way too high, and here the risk reward is not good. And there is a fourth reason, okay, that I didn't write here, is I don't feel comfortable holding Tesla for 10 years. This is personal. Like, maybe you feel very comfortable by holding Tesla for the next 10 years, and if yes, great. But personally, I don't feel comfortable by holding Tesla for the next 10 years because I have no idea where it will go in 10 years. I'm not saying you need to know perfectly where the company will go in 10 years, but with Tesla, I have absolutely no idea how the future will look like. I have no idea what they will do, what they will not do. I have no idea if they can grow, where it can be, how the market can be for this type of cars and type of company. So that's also a reason. If you can see clearly where Tesla is going in 10 years, why not? But to be fair, I don't see it. And all those three reasons, plus the valuation right now, like even if for you all of this is not a red flag and you want to invest, I'm sorry, but the valuation is too high right now. Okay, you saw it. The valuation is too high. The PE, you cannot buy something for a PE ratio of 110 or for a PE ratio of 83. Eventually, if it was a startup, why not? But it's not a startup, it's a public company that is worth $750 billion. You cannot accept to pay that much for a company like this, even if there is Elon Musk, even if Elon Musk is a genius, even if Tesla is a future and it will be one of the biggest companies in the world. Why not? But you cannot pay that much for a company. You cannot pay 83 times forward PE for this type of business, even if you believe that all of this is not a red flag and if you believe that you could keep the company for the next 10 years. Okay, that's all for the video. If you have other view on Tesla, I will be very happy to read it in the comment section. I want to deepen my knowledge on the company. It's not something that I have in my portfolio. So if some of you have in your portfolio, I will be very happy to listen to your theory about the stock. Also listen what are your play on it. Maybe also you're a short-term player. Maybe you just want to do a quick move or with some options or I don't know what, and you're a trader, so you're not a long-term investor, because I need to precise, I'm a long-term investor. When I buy a stock, the goal is to never have to sell it. So if you're maybe a short-term investor, I could understand maybe a bet on Tesla, but I will be happy to read all of this in the comment section.